Hello and welcome to the Investing Collective YouTube channel and podcast. Today I am delighted to welcome two global equity fund managers that have nearly 70 years experience between them. They have worked at and run money at institutions such as Artemis, Rothschild's Asset Management, Phillips & Drew. They've run institutional money, they've run mutual funds, they've run investment trusts. Gentlemen, welcome to the podcast.
Thank you very much.
Simon, nice to see you again. Before we talk about portfolios, etc., do you want to just tell us where Goshawk came from, how it came about? Because people may know you from your days at Artemis and before then. So how did Goshawk come about?
Well, the basic idea of Goshawk Asset Management is this is an equity boutique focused entirely on global equities, run by people with a large amount of experience. So the team upstairs is of 6 people. The 5 fund managers have an average experience of 32 years. And the backing of Harwood Capital gives us long-term support as we grow this boutique.
And so the genesis of the boutique, you left Artemis a couple of years ago, you wanted to set up something that specialised in global equities and nothing else effectively. Is that something that is going to stay into the future, or is that just a starting point?
I think if you look at some of the successes in our industry, it's those businesses that have been distinctive and single-minded in terms of what they are trying to achieve. We know that our skill set is running global equity funds in a risk-adjusted manner, and we want to stick clearly to our skill set and do it at a reasonable cost to run a number of products which appeal to a vast array of different investors.
And you said the team's got on average 32 years experience each. You're coming up for 30, Alex, and Simon is a little bit further north of that, on the 40 mark. What was it that got you both into fund management in the first place, and what is it that keeps you in it today?
Well, I spent the first 15 years of my career as a stockbroker. And then I joined a firm called Tallbox and Stonex, run by a chap called Niels Tall, who was a very well-known fund manager. In 2000, I joined him. We mainly ran funds for St James's Place. So running investment funds is perhaps where all the equity side of career ends up. After all, it is the job. You're either trying to raise money for companies, or you're investing in shares trying to make you and your investors wealthier by running money. And global equity funds gives you the broadest array of opportunities to do that. So it takes a long time to learn about all the stocks in the world, or all the significant stocks in the world, to be able to compare and contrast them. So over time you feel that you can bring all that knowledge together to produce sensible portfolios of high quality companies on sensible valuations.
And Alex?
I think it's that broad opportunity set is the phrase that I pick up on from what Simon said, which is what gets you out of bed every day. It's enormously exciting, a privilege to run money on behalf of savers. But you're constantly meeting new management teams, you're constantly understanding new strategies. And often, as you will know from your experience in this industry, you're not always right. And being wrong a lot of the time reminds one that one consistently has to learn, continues to learn. So that's really why I've stuck to it. But I've always wanted that broad opportunity set, because I felt that if I can invest within that in a risk-adjusted manner, it's how I want my own money to be managed.
And how long have you worked together as a team?
Well, I think we're at 15 now.
Yeah,
15 years.
15 years, yeah.
Excellent, good.
Stop counting.
It's too much of a good thing. No. Right. So let's talk about Goshawk and the funds that you manage at Goshawk. And you've got 2 funds here at the moment. You've got the Goshawk Global Fund, which is a mutual fund, and then you've launched an active ETF, the Goshawk Global Balanced UCITS ETF. Let's just talk about the ETF, I think, to start with. Give me a detail of why you've launched it, why you think that's a vehicle that is good for investors, and then we can go into a bit more detail about how the team works and how the portfolios are constructed?
Yes, no, I will. I think the active ETF is just a fantastic wrapper for savers, and I will give you some reasons. But when you think about building or rebuilding an equity boutique, and you study some of the direction of travel of our industry, I do feel that ETFs, and in particular active ETFs in Europe, are going to be more numerous than they've been in the past. And the real reason is that mutual funds have some old-fashioned quirks to them which don't always suit, certainly the younger saver. For example, single pricing every day. An ETF is more analogous to an investment trust in that it's constantly trading exchange traded. So it offers a very cheap, easy to access opportunity to buy an active product, simply an active product. So,
sorry, I'm going to butt in. Lots of people in the past have seen ETFs as a passive product,
correct.
and those funds, those ETFs that have been marketed as active ETFs, certainly up until a year or so ago, weren't really active. They were sort of enhanced index, so index plus a little bit. You're talking about putting a proper, fully active fund with, you know, concentrated holdings. You're not tracking the benchmark at all into this ETF wrapper.
we see no reason why the wrapper, the ETF, shouldn't be used to run a truly active fund.
Okay, sorry, I interrupted you. I just wanted to clarify that because some of the people listening to it might not know there's that nuance. So go back to, it's a good wrapper. It's got lots of benefits to it. It's easy to access. It's intraday traded on stock exchanges, etc. Cheap to run, cheap for investors to access. What are you trying to do within the wrapper then? In terms of what's your elevator pitch? What's your objective? What should investors expect from you?
Well, I think just the first thing to say about the active ETF is that it works particularly well for a product such as ours. So if you think that we're looking for businesses that have quality characteristics that offer us for value for money around the world, these are large, these are liquid assets which suit perfectly an active ETF structure, where not only should you deliver high returns, but you also need to make sure that the spread on the share price is very tight. So in large liquid names, being the underlying securities, I think you're always going to achieve that. Maybe, you know, Simon will say something in a second, but what we're really trying to do with the active ETF is remind ourselves what the person on the street needs to do from equities to beat inflation. And so come to the equity market with that mentality. Look for businesses that can look after themselves, that have the compounding of cash flows within their business, but provide a product that has some stability to it in terms of the way that the portfolio is built, and whether that means a small allocation to short-term gilts or an allocation to value type equities at certain times in the cycle. We are investing in risky assets. The bulk of the product is in the equity market, but we're hoping to provide some stability or some consistency to the set of the returns, and therefore offer a core savings solution for the end investor.
And you talked about, very briefly there, looking for quality assets at an okay price. What does that mean in terms of the type of things you're looking at within a stock when you're looking at its reporting accounts and what are the metrics, etc.? What does that actually mean to an investor?
So the portfolio of the ETF is built up with a core of what we call high quality companies. People talk about high quality companies a lot. But the key thing is that they make things that people need, and that they make them better than other people, or they don't face a huge amount of competition in what they do. Normally because their products are exceptional and globally dominant in their areas. And so a company like that you should expect to see has very high levels of profitability. Also, because of the high levels of profitability, you'll tend to have a strong balance sheet. And if it's in an area where requirement for its products is growing, then it'll also be able to invest for the long term by reinvesting those profits, coming up with new products, and growing the shareholder value from that point of view by compounding returns, what we call compounding returns. As long as they can invest with a similar return on investment from their past returns, either because they got strong brands or strong reputation, then that's the sort of thing which powers share prices over the long run. And that's what we want as the backbone of our portfolio.
Well, just to further on, you said what metrics in particular. We are looking for a cleaned up cash flow metric, but we're also trying to work out what it would cost to compete with that business. So it's an analysis of the cash flow statement, but also the balance sheet.
So if you're a manufacturer of high quality widgets, your competition to put that in place would have to be able to build the factories, build the network, build the distribution, etc. You're looking for ones that have got what one would call a bit of a moat around them. It's going to be difficult to replicate that quickly and easily.
Correct. We want to understand the drivers to allow them to continue to earn those supernormal profits in economic terms. And then we want to put a value on that business, which is not just the tangible assets that the company might have built, factories in your example, but also the intangible assets that the business has built up, whether that be through brand names or network effects or other types of intangible assets.
And do you find when you're putting the portfolio together, you find certain types of sectors appear more readily than others, or is it right across the piece and it's just all bottom up and it's just one stock at a time? Does it fit the characteristics or not?
Technology companies typically have this sort of dominant market share. So if you go through the big technology companies, there is a choice. You don't have to buy an iPhone, but if you want an iPhone, there's only one person you can get it from, and that's the only phone that will also talk to your computer, and so on and so forth in a simple way. Similarly, Microsoft Outlook only comes from Microsoft. So technology companies have tended to be a large part of what we invest in. But as we mentioned earlier, we won't invest in them if we think that the valuation's too high. And so while we have a lot of money in technology, we probably have less than the index these days because everyone has alighted on it. On the other side, we'll have branded goods companies, as you mentioned, luxury goods companies, perfume companies, and so on and so forth, who again enjoy very high levels of profitability through their developing brands that people want to buy. On the other side, there are quite a lot of sectors which we hardly ever invest in because they're highly competitive, such as the building industry, chemicals industry. So the portfolios don't tend to have any exposure to these sectors, which typically are very sensitive to the economic cycle. So when there are recessions, our companies are seldom bothered as much as the average index portfolio because we just avoid these cyclical sectors.
And in terms of how does the team, there's 6 of you upstairs, how does the team work in terms of coming up with the ideas? Who's responsible for doing the research? Who's responsible for executing the trading or the percentage you're going to put into a portfolio if it's got all the way through the due diligence process? And what sort of stocks or companies or sectors create red flags? And you alluded to some of them there in terms of places you wouldn't go when you're investing, or perhaps put it another way, what would trigger you to sell an existing holding that you held for some time in the portfolio and actually I'm going to get rid of it now?
So there are 2 funds here. Alex runs the ETF, Goshawk Balanced Fund, and Tim Gregory manages the Goshawk Global Fund, which is the UCITS fund. The portfolios are very similar in terms of the individual stocks that we own in them. The ETF has more of a capital protective bias towards it, and so in the more expensive names, such as the technology names, we'll tend to have smaller holdings in them than we have in the UCITS fund, which therefore is slightly closer to the index. It's very lumpy holdings in the index these days. Still not as big as the index, but all the same. So there's a more smooth approach in the ETF and something extra bias towards companies on lower valuations with more asset backing, which can cope with recessions, which can cope with more turbulence, if you like, in the ETF. So that's the style difference, and the two managers choose how to size the positions on that basis. But the stocks are basically the same between the two funds. And the stock list won't change all that often because we pick these companies for the long run. We like what they do, otherwise we wouldn't have picked them. And we're hoping to see that compounding of returns. But we're also very vigilant on two things. Firstly, whether they offer good value for money. So we reduce holdings if even the holdings of our most favourite companies, we'll sell them down a bit if we think the valuations have got too high. And you asked about red flags. Mainly there are sectors we avoid. Cyclical sectors, sectors where government interference is too high. Countries where we think that there's a possibility we may not be able to sell our shares and get the money back. So we limit ourselves to safe areas to invest by sector and by country. But in terms of stocks, if a company starts heading off in a direction which is different from the direction we expected it to head in, then we'll immediately review the stock and potentially sell it. So yeah, companies we've known for many years, it hardly ever happens, but once in a blue moon they'll go make a large, over-ambitious acquisition,
Yeah.
and then we think, we weren't expecting that, that's not what we thought this company would do, perhaps they're biting off more than they can chew, and then we'd immediately review the holding.
And you talk about stock list there. I mean, how many stocks do you have typically in the portfolio?
So we have about 60 stocks in the portfolio, and that comes from a core list of 350 odd stocks that we're looking at.
And that
We
300
continue the bird theme. Our stock list, our long stock list, is called Golden Eagles stock list.
Right, and that 350 stocks on the Golden Eagle list, that is, going back to what we said, typically highly liquid global equities in markets that you think you can get your money back.
Yeah, that's
Yeah.
the list of quality stocks.
Yeah.
But at any point in time, some of them are going to be cheaper than others.
Yeah.
Some of them are going to suit the circumstances
Yeah.
more than others.
And does that 350 list change a lot,
Very
or is it
seldom.
very seldom? Okay.
The way that list is compiled is through writing. We call them actually roadmaps around certain areas of secular growth, pockets of the world where we think there will be a consistent amount of growth going forward, and therefore a number of companies can profit from them. So we try and find, let's take an area like healthcare, where clearly governments need to lower the cost of provision of healthcare to aid an aging demographic, for example. Which of the companies around the world have that ability to be able to provide lower costs to the governments or the main insurance companies? And then we will try and research the companies that are best positioned to be able to benefit from that area of secular change. But we do want that area of secular change to drive the cash flows.
Yeah. And let's just go back to, you talked at the very beginning about how you were trying to make sure that investors achieved a better than inflation return from the portfolio, from equities. Is that the formal objective, or is that just one that you as managers have in your mind at any one time? And if not, what is the formal objective that people would expect?
Yeah, I mean, it's the only objective that you're likely to set. Nobody's going to put their money in an investment fund if they don't think it's going to mean that they end up wealthier at the end of it all, in real terms.
Yeah.
Obviously, you can't prove it. Stock markets go down as well as up. There are fees involved. But as long as you're picking good businesses which can cope with turbulence, equities have proven to be an extremely good investment product over the long run. But I think it is very important to emphasise that the sort of companies we invest in can take 5 or 10 years to show their true value. I mean, markets can hold equities as being worth less than they are for really quite long periods of time. We have to be patient, and we would hope that people who save with us choose to be patient alongside us.
And are there certain market environments that make your life more difficult as fund managers? And there are certain market environments that make them easier as fund managers?
Well, relative to other people, we probably take quite a lot less risk than many people, particularly as the market rises, we get nervous. Hopefully we also get braver as the market falls, but there haven't been many falling markets for the last 15 years. But no, we'll back off a market where we think that there's over-exuberance, or people are getting too greedy, or valuations are too high. And we'll probably do that rather earlier than other people. So our funds are very likely to underperform the index, if you like, at the last bit of a bull market. And then make up for it in corrections. And that's been our history working together over the last 15 years, and the same with Tim and his team.
So capture a chunk of the upside, but not necessarily all of it, but try and avoid losing as much money if the market turns against you.
Yeah. So the interpretation of risk is much more about absolute loss of capital than risk versus a benchmark, which I think fits with an earlier comment I made about trying to deliver strong risk-adjusted returns.
I'm going to ask you a final question now, which it's not necessarily to do with the portfolio, but I think it would be interesting for viewers and listeners to just hear. As a fund manager, what have you learned from your experience of running money 30, 40 years? What's a key lesson that you've learned that you try and put in place on an ongoing basis, or try and avoid if it's a bad experience?
Well, I would say something I said earlier, which is a great privilege to run people's money, hopefully to make their retirements a happier experience. I think I've learned to be humble by being, often wrong, and I have learnt, hopefully, from those experiences to make sure that one makes most of the right decisions in the right shape going forward.
Simon?
Well, the thing I'd add is that companies are remarkable vehicles. I mean, it's a bit of a surprise sometimes that we're allowed to buy shares in them. We turn up with our check, we buy some shares in this company, and there are all those people much cleverer and more hardworking than us, who then run around trying to create value. Getting in early, inventing products, selling products, gathering up cash and profits, and then coming up with new stuff, and the share prices go up. So I think owning shares has always been a fantastic thing to do. The other thing I'd mention is that companies outlast governments. They get through wars. I mean, they're remarkably resilient.
Yeah.
So I think one of the other tricks is not to get too carried away, too worried about the political noise out there or the economic noise out there. A well-run company will steer its way through remarkably difficult conditions without too much damage to your savings. As long as you can wait for happier times to come along.
The key to being invested in equities and slightly riskier equities is patience. So
absolutely.
Yeah. Gents, it's been absolutely fascinating to have this chat. Thank you very much indeed. I think we could carry on talking about portfolios and Goshawk for some time, but we've used up lots of your precious time. So on behalf of the listeners, thank you very much indeed.
Thank you.
Please remember that the Investing Collective is not offering investment advice or recommendations on investments. Everything that you hear today represents the views of the interviewer and the interviewees as at the time of recording, and those may change without notification or reference. The Investing Collective makes no warranties or representations regarding the accuracy or completeness of the information contained in the podcast. This information represents the views of the interviewer and the interviewees at the date of issue, but that may be subject to change without reference or notification. The Investing Collective does not offer investment advice nor make recommendations regarding investments. The content of this podcast is not deemed to constitute financial or investment advice in any way and shall not constitute a regulated activity for the purposes of the Financial Services and Markets Act 2000. This podcast shall not constitute nor be deemed to constitute an invitation to induce an individual to engage in an investment activity, and should you decide to make any investment decisions based on the information contained in the podcast, you're advised to seek appropriate advice before taking those actions, and you do so at your own risk. Thank you for listening.